Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. Stock Market Overview. Earnings, Tech Levels, and S&P Forecast. This video presents a direct informational narration of the source document. Our source document covers 6 main sections today. We'll briefly review the broad market and sectors, move into semiconductors and cybersecurity, look at the megacaps, dive into specific earnings analyses, review a recent S&P forecast, and finish up with technical levels. Section 1. Broad market and energy sector constraints. According to the document, as of 8:15 p.m. Eastern Time on May 27, 2026, the 4 major indices traded flat. S&P 500 component stocks were evenly split between advances and declines. Among the 11 sectors, consumer discretionary and consumer staples led the market. The energy sector, however, underperformed, driven by a decline in international oil prices. Brent crude is currently near $93. If it breaks below $90, the energy sector is highly likely to break support and form a top. Energy sector levels are precisely between 55.50 and 57.90, closing near 57. It's noted that a breakdown in energy prices would constrain optimism for oil, but serve as a significant tailwind for sectors impacted by high energy costs, such as consumer staples, travel, and airlines. Section 2 covers the semiconductors and cybersecurity pullback. The Philadelphia Semiconductor Index, or SOX, showed notable weakness, with 27 of its 30 component stocks declining on expanding volume. Key decliners included QCOM down 6%, MRVL down nearly 5%, TXN down 3%, and ASML down 2%. Concurrently, the cybersecurity sector experienced a sharp sell-off. This was triggered by poor forward guidance from one component that plummeted 31%, which dragged related cybersecurity stocks such as PNOW, CRW, and FTNT, which were previously at new highs, down by approximately 3 to 4%. Section 3 examines megacaps, specifically Meta and Amazon's strength. Among the megacaps, Meta and Amazon demonstrated strong performance on high volume. Meta is rolling out 3 paid software subscriptions. This includes 2 products for enterprises and creators, priced at $14.99 and $49.99 per month, with plans to integrate AI agents. While current revenue expectations for this are small compared to its ad business, it marks a vital starting point for AI monetization. Technically, Meta's long-term accumulation zone is between 500 and 700. Technical resistance lies strictly between 638 to 680 and 690 to 730. A breakout is required to establish a new upward trend. AMZN's trajectory is much simpler, an upward move on high volume indicating a new high trend. Its recent pullback lacked downward momentum and occurred on flat to shrinking volume. Section 4 dives into MRVL earnings and valuation. Moving to Marvell Technologies' Q1 earnings, revenue reached $2.42 billion, exceeding the $2.41 billion estimate. Adjusted EPS was $0.80, which was in line with expectations. Data center revenue was a standout at $1.83 billion, beating the $1.81 billion estimate and growing 27% year over year. For Q2, guidance projects EPS of $0.88 to $0.98, the midpoint of which is above the $0.90 estimate, and revenue of $2.57 billion to $2.84 billion. Regarding valuation, the forward EPS estimate for the January 2027 fiscal year yields a valuation range of $114 to $152. For the January 2028 fiscal year, the range is $161 to $215. With the current price at $218, it exceeds the upper bound of the 2028 estimate. This indicates the market has already pulled forward 1.5 years of valuation. Technically, MRVL has formed a standard topping pattern on high volume over 2 days, fully absorbing the upper shadow and prior highs. But as the source document notes, technical patterns represent high probabilities of over 68%, not 100% certainties. There are no absolute guarantees in financial markets. Assuming 100% certainty would break options pricing formulas and mathematics entirely. The immediate support levels are 198 to 10. And here, I must note that the source text appears incomplete at this specific point. Above that, there is upper support between 189 and 195, and stronger support at 182 and below. This topping pattern is invalidated only if the closing price exceeds 218.26. Next, we look at CRM mixed earnings and AI transition. Salesforce, ticker CRM, reported mixed Q1 results. Adjusted EPS was $3.88, beating the $3.13 estimate. Revenue was $11.13 billion, up 13% year over year. However, the $8 billion acquisition of Informatica contributed $444 million, accounting for one-third of this revenue growth. Current remaining performance obligations, or CRPO, grew 14% to $33.6 billion, missing estimates and indicating slowing growth. Q2 EPS guidance of $3.26 beat by 1 cent, but revenue guidance missed by $40 million. While the company hasn't seen user decline, its agency force AI annual recurring revenue just crossed $100 million. For a company projecting $46 billion in annual revenue, the AI-driven revenue effect remains insignificant, requiring time to prove its growth acceleration potential. CRM's forward valuation for the January 2027 fiscal year is estimated between $263 and $395, and for January 2028 up to $443. While mathematically undervalued, the market remains skeptical due to the lack of significant AI-driven revenue expansion. Technically, recent strong support sits between 156 and 170, and again, the source text appears incomplete here. The heavy resistance zone above is strictly defined at 180 to 190. The stock is expected to consume time in sideways consolidation. Section 5 details the Goldman Sachs S&P 500 forecast. Goldman Sachs raised its year-end S&P 500 target to 8,000, representing approximately a 6% upside from current levels. This upgrade is driven entirely by upward revisions to earnings estimates. They raised the 2026 S&P 500 EPS forecast to $340, a 24% year-over-year increase. Half of this increase is driven solely by massive EPS upward revisions from AI beneficiaries, such as Micron. The 2027 EPS was raised to $385. The market is highly fragmented right now. The S&P's elevated levels are supported by a few semiconductor stocks, while many other companies continue to hit new lows, squeezed by high inflation, rising raw material costs, and an inability to raise consumer prices without destroying demand volume. Moving to Section 6, we have the TSLA, technical parameters. For TSLA, momentum is increasing within its established 420 to 465 range. A strict invalidation, or stop-loss level, is set at 419 based on the closing or subsequent opening price. Falling below 419 closes the short-term momentum window, signaling a return to downward testing. Conversely, breaking above 465 opens a larger upward wave toward prior or new highs. At a hypothetical price of 439, the downside risk to 419 is $20, while the upside to 465 is roughly $25, with potential extension to $35, $45, or more upon a breakout. This outlines a precise risk-to-reward ratio for probability-based swing trading. Finally, we look at semis and software rotation dynamics. The broader semiconductor index displays a warning structure, though confirmation requires continued downside movement. Key support is distant, located at 489 to 521. Short-term semiconductor movements are currently dictated by capital imbalances and option squeezes, rather than fundamentals. Meanwhile, MSFT and GOG remain in flat consolidation. The software ETF, IGV, maintains its upper structure. If speculative funds rotate out of semiconductors, IGV could see a short squeeze yielding a roughly 10% move toward the $100 mark. IGV's recent declines on shrinking volume indicate potential entry points for structured pullbacks. That concludes our overview of the source document.